So this accounting interview question was asked in all my internship and graduate Big Four interviews. It was asked in my credit rating agents interviews, as well as in all my risk analyst interviews. It's safe to say this is the main question you're going to start off with in any job related to accounting or finance in an interview. And I'm going to give you a perfect, concise interview answer. So let's get started with the video. So this video will be short and to the point because I want you to use this answer in your accounting interviews, whether that's for accounting roles or risk analyst interviews, and that is, can you tell me about the financial statements? Now, understanding the 3 financial statements is absolutely crucial. So what's the best interview answer that you can give to this question? Now, of course, the 3 financial statements are the balance sheet, the income statement, and the cash flow statement. And I'm going to start off with the balance sheet. The balance sheet shows a snapshot picture of the company's assets, liabilities, and shareholder equity, with these 3 interacting with each other via the formula assets equals liabilities plus shareholder equity. With this formula, it's possible to see how the assets, items such as cash or equipment, are being funded, and this will either be through liabilities, for example a loan, or equity, in other words money from investors. Hence, this is the reason why the total assets are equal to the liabilities plus equity. However, one drawback is that, as mentioned, it's only a snapshot of the company at one point in time. The 2 other financial statements show a much more dynamic picture of the company, and this leads on to the second financial statement, the income statement, or sometimes referred to as the profit and loss statement. This summarizes the revenue the company is bringing in, as well as the costs and expenses associated with the course of business. It's also here that you'll see the profit figures. The income statement is more dynamic than the balance sheet, as whilst the balance sheet shows a snapshot of a point in time for a company, usually the last day of the fiscal year, the income statement shows the change over a set period of time, usually 1 year. Now, the last financial statement is the cash flow statement. Here you'll see the movement of cash coming in and out of the company. Now, it's important for reviewers of the financial statement to see that this shows how well the company can generate cash and if it can cover its obligations such as expenses or interest payments. Another word for this is liquidity. There are 3 main areas of the cash flow statement, which are operating activities, the main cash generating activities the business exists for, investing activities, cash movements related to the investments, and financing activities, which relate to cash movements from investors or dividends, to name 2. One great thing about the cash flow statement is that the inflow and outflow of cash is a lot harder to manipulate than, say, profits reported in the income statement or accounting recognition treatments of assets which are reported in the balance sheet. At the end of the day, cash is always king. And that's it. Simply use this answer in your accounting, risk analyst, or financial analyst interviews, and it'll give you the best start to the interview, with the interviewer seeing that you already know the basics of what the job actually is. Now, after this question, you'll likely be asked more about your commercial knowledge and how can you assess a company beyond the financial statements. I've made a video for this and we'll leave a link to it after this one, so go check that out, and I'll see you all in the next video.